Hello and welcome to today's podcast. I am Jason Drucker, the Chief Commercial Officer of SFC Capital, the UK's most active early stage investment fund, coming to you on Friday, the 25th of October, 2024. And today I'm joined by two very special guests and my peers and colleagues from SFC Capital. Stephen Page, the founder and CEO. Hi, Stephen.
Good morning.
And Ed Pryor, the head of investor services. Hi, Ed.
Hi, Jason. Good to be here.
Thank you both for joining us. So, listen, as we all know, the UK's budget is just around the corner on Wednesday, the 30th of October. We'll be glued to it, as I'm sure everyone listening will be as well. So today, what we're going to do is dive into what we can expect from the budget, particularly in areas like investment incentives and tax policy, and of course, the startup support. So let's kick off with you, Ed. As the head of investor services and with lots of previous experience in the world of politics, how are you feeling about the government's first budget?
Well, there's been a lot trailed by the government over the last couple of weeks. So we all have a pretty good idea of where it's heading in respect to investing in startups. The four big changes that have been trailed are potential changes to capital gains tax, to inheritance tax, to entrepreneurs relief, and then to employers' national insurance contributions as well. It is worth noting, though, that there are kind of tactics that governments use to get out bad news ahead of a budget and then shape the narrative when the budget comes, but also they sometimes test ideas through the newspapers. So under the previous government, you'd often see potential ideas tested in the Telegraph and the Financial Times at budget time, and they measure public reaction or really more important to them, their voters' reactions. And under this government, they use the Financial Times again, but also the Guardian to measure that reaction. So we can't be 100% sure what's going to be included. Potentially, they've got the bad news out the way to then deliver a more positive message on budget day, or they've just been testing ideas before making final decisions. So I'm not entirely sure what the budget will look like specifically, but I think we have a general feel that they're going to be going after tax revenues, trying to make up for an apparent shortfall in the overall budget. And I think the whole investing and startup community is a little bit braced at the moment, waiting for what's going to come.
Thanks, Ed. It sounds like I need to update my newspaper subscriptions. Throwing it over to you, Stephen, what's your perspective? And in particular, I'm thinking about the enterprise investment scheme and the seed enterprise investment scheme that SFC Capital has been so powerful in supporting over the years.
Yeah, I think it's unlikely and very doubtful there'll be any changes to the schemes specifically in the budget. Obviously, they've got a lot more to talk about. Recent times, we've seen the government make changes. 2 years ago, the SEIS limits were increased quite substantially, which was fantastic. And the recent extension of the sunset clause for the EIS scheme, I think that was about 6 months ago. So unlikely to be anything specific to our schemes, but there will be probably some things that may concern us on the periphery, such as I would like to see the entrepreneur relief not increased so that there's a real motivation and incentive for entrepreneurs to get to an exit and make money so that they're not, but there will be a problem if the tax rates are increased substantially for that. One or two other things that may also have effect on our schemes. The inheritance tax may be levied on SEIS and EIS investments, which would be a blow to older people making investments in those schemes. And I hope that is not implemented. Additionally, the high net worths who may leave the country as a result of the non-dom changes, as well as CGT going up, may result in less investment in our schemes, because at the end of the day, it is the higher paid people who are making a lot of investments under the schemes. And it's a very good recycling of their money into startups that we need desperately.
Interesting. Throwing it back to you then, Ed, what do you think are the risks that might be involved if the government increases CGT and or inheritance tax?
Well, one thing we really don't want to do is see an exodus or a continued exodus of high net worth net worth leaving this country, because they are the key investors in the next generation of innovation through startups that are going to define the next 10, 20 years of our economy. I think the current government inherited a tricky situation with the UK being second only to China in terms of millionaires leaving the country. And what we don't want is to exacerbate that problem even more. I think with changes to CGT, if there were to be increases to CGT, that's a real risk, because what we absolutely don't want to do is cut off the key drivers of growth. And I was doing some sums just a couple of days ago to work out how much this £20 billion shortfall that the government talks about actually means in the grand scheme of the overall government budget. And it equates to about 1.16%. So what I would really hope that they don't do is make decisions that will cut off growth in pursuit of that 1.16%, because I'm sure there are other ways of tackling that 1.16% problem.
Interesting. The old sledgehammer and nut idiom comes to mind. Stephen, what do you think the government could or should do in order to stimulate growth in the economy, perhaps through the less kind of obvious measures or methods, the things that won't be talked about so much in Rachel Reeves's budget on Wednesday?
Yeah, I think the one of the big problems in the UK is the perceived funding gap. We're very good at providing seed funding, but we're not very good in this country at providing the, let's call it Series A and on funding. And there's lots of reasons for that. But what we've seen recently is some good work done that I'm really hoping will continue to be done. And that's particularly around partnerships between the public sector and the private sector, and in particular, specifically unleashing this enormous amount of money that's locked up in pension funds. And as we know, the previous government had Chancellor at the Mansion House speech about 6 or 9 months ago, did talk about it. I think it may even be longer actually, but did talk about this. And there are some interesting things happening now around that, such as a new fund called Investing in Women, which is a £250 million fund raised through combination of public money and primarily private sector pension money. And I'm really hoping that this government can see the real benefit of that and will start to do similar initiatives, and certainly not curtail good initiatives that are out there already. And this is also where the British Business Bank comes in, which is an excellent public sector investment bank, which has been doing really sterling things. And more money for that, an increased budget for the British Business Bank, would also go a long way, or partial way, to solving this big problem. And I'm hoping, as a government of innovation and wealth building business, as they say, that they do put their money where their mouths are and continue to, really get these initiatives off the ground.
I think that's a really important point that Stephen's hit on it. And we see it with our portfolio as well. Many of our superstars struggle to raise growth capital here in the UK. And we really need to work at improving that synergy between the seed and the growth stages, because otherwise we become excellent investors at growing, at founding the next big thing. But we're losing all of the value to UK PLC of those businesses when they go in search of growth funding in other countries. And many times, often, they will then have to relocate to that country, like the US, to get that funding. So what we don't want to be doing is inventing that next big thing, but not benefiting from it as a country.
And indeed, the fact that the private sector can be brought into this, it will not cost money. It will not cost the government money. It's a regulatory, and they need to press the button on this. So that releases all this private sector money that's sitting in many places and not being used effectively to build this country. But, so it doesn't cost money in the budget per se.
And speaking of buttons, let's add to that levers, and we will find out on Wednesday which ones Rachel Reeves decides to pull. Stephen and Ed, thank you so much for joining us and for your insights shared today. Thanks to anybody who's listening. We will be watching very closely on Wednesday at around 12:30. We will update you on what we think it means for the early stage investment environment in the UK. So please do be sure to follow SFC Capital for updates. And thank you for listening.